All right, everybody, Economic Ninja here. Let's go to the whiteboard. Let's do a little bit of real estate class. Now, for everyone that thinks that real estate's not going to go down, that it's going to keep going up, well, I've got a little news for you. This time is different. Yeah, I've heard that before. Everyone usually uses that in the whole context of, no, it's not going to crash like it always has in the past. Yeah, in the past when rates go up, it gets too expensive and then there's a bubble pop. Oh yeah, in the past when there's inflation, they sort of get in control and everything's okay. In the past, they always have these reasons that it broke, but this time is different. Every single time is different. Well, you know what? I'm going to tell you right now, I'm going to prove it with the adjustable rate mortgage product that it is different. It's actually quite worse. So here we go. So let's go through a couple of bullet points. Rates have increased to a 20-year high from December of 2020 to October of 2022. And as a matter of fact, just recently, they're starting to uptick again. It's very important to understand that because every time interest rates go up, and they're always started with the Federal Reserve. As the Federal Reserve starts to raise rates, their benchmark rate, obviously banks raise the rates that they're going to loan you money for, right? Because if it costs them more money to loan it from the Federal Reserve to loan to you, they still need to keep a certain margin, so they're going to charge you more, right? Another variable has to do with risk. If you are either looked at as a credit risk or the bank is taking on too much risk, they're going to adjust those rates and the fees they charge for money accordingly. But right now, we have seen rates increase on a plane that we have never seen in the last century. Now, the 30-year fixed rates jumped 422 basis points in this same period from December of 20 to October of 2022. And I just want to use this example and to keep it all the same. So as 30-year fixed rates jump 422 basis points, check this out. Adjustable rate mortgages only jumped 292 basis points. Now we're using the 5-1 ARM as an example. And a 5-1 ARM means that it is a fixed rate, an introductory rate for 5 years, and then it adjusts from there, okay? Now before you say, oh wait, Ninja, that means that everyone that got into adjustable rate mortgages are gonna be okay for the next 5 years. Well, guess what? We're going to go back in the past, and it didn't even take 5 years for all the people with adjustable mortgages to start bailing from the economy, from the housing market. So check this out. As home prices rise, people race to adjustable rates, and it's happening right now. The usage of adjustable rate mortgages, I'm going to get into the percentages in a second, are quite staggering. The facts are when people move in at the top of the market, as home prices are going up, you go see your real estate agent, and they say the same thing. If you don't buy now, you're never going to get to own a house, so you race in and you have what's called FUD, fear, uncertainty, and doubt. Point being is that you got caught. You got emotional and you dove in probably without thinking. And what was the one way you were able to get in? The only way possible, an adjustable rate mortgage. Why? Because the interest rate is less, and that's the one factor that you're usually able to change. It's hard to go to the county assessor and
say, hey, I want to pay less in taxes.
Or going to the insurance man and going,
hey, I don't want to pay that much in insurance.
You can shop around, but by and large, it's all about the same price. But the one thing you can affect is the type of loan you have, right? So a lot of people race into there, always being told the same thing by their loan broker, saying,
don't worry, the Federal Reserve is going to pivot. They're going to lower rates soon.
And that's exactly what loan officers were telling me back in 2005, 2006. Now, I was already a real estate investor for so many years, but I was in the middle in 2005 of selling all my properties. I only kept 3 because I saw this crash coming for the exact same reason. Now, it says here, since 2007, the housing burst, people returned to the fixed rates. You see, when everybody dove into adjustable rate mortgages from mid-2004 to 2007, they dove into fixed rates. And the reason why they went from adjustable to fixed, because the Federal Reserve already saw the bubble had burst in 2006 and they started drastically lowering rates. It actually started a little bit in 2006, 2005, when they saw it plateaued after a long term of running up, it plateaued the rates, and then they started aggressively diving it down. Now you remember that the big crash, the Great Recession, is called the Recession of 2008. Why? Is because it took so long for the public to figure it out, to shake everybody out of their homes as people are losing their jobs, losing their homes are going into foreclosure or to short sales. It took a long time, but by that time, the damage was done. The Fed could not lower rates aggressively enough to take care of this. I go into more of this in detail in my course. If you want to look at it, I'll put a link below. 20% or 80% off, and makes it $199. But you need to have these easy, logical points from history to be able to see what's going to happen in the future. So people started diving into these fixed rates because why? The Federal Reserve was dropping rates. Now, the people that were running into these fixed rates weren't the people that were losing their home. They were already in trouble. They were losing their credit score. They were behind in payments. They were in trouble. We're talking about new buyers, okay? People that are sitting on the sidelines. And that's what I want you doing, getting ready for this next crash. Now, adjustable rate mortgages declined from 45% in mid-2005. That's how many of all loan originations for conventional loans, 45% of them, 45 out of 100 loans in 2005 were adjustable rate mortgages. You could see where this was really bad, right? To a low of only 2%. So 2 out of 100 mortgages in 2009 were adjustable rate. Why? Because they weren't a good enough deal. Fixed rates had come down so much. But now it changes. You see, since then, adjustable rate mortgage shares, they fluctuate between 8 and 18% of originations, okay? So any given day of the last 10 years, we sit between 8 and 18%. Adjustable rate mortgages declined to a 10-year low of 4% of originations during COVID. Why is that? Well, rates were already pretty historically low. Mortgage rates were sitting around 4.5%, maybe 5% if you had shady credits, some little ifs there. But when COVID happened, the Federal Reserve took interest rates and did a swan dive. And coincidentally, so did mortgage rates. So people stopped buying using adjustable rate mortgages and they dove into fixed rates. Well, this is the trap. You see here, as fixed rates rose, when the Federal Reserve in 2020 said, hey, we're going to get on top of inflation, they didn't start raising yet. They actually didn't start their first rate hike for 4 months. The market started moving immediately. Banks saw what was going to happen. They knew the Fed was going to raise rates. So what did they do? They started incrementally bringing up mortgage rates, okay? So since December of 2020, rates started rising from a historic average of a fixed 30-year mortgage rate of 3%. ARM adjustable rate mortgage use rose where they hit just recently in 2023, April of 2023, 18.6%. Now, why is this important? Well, let me get to that in just a second. This is 18.6% of dollar volume of conventional single-family mortgages, which is a 4x from the all-time low, or not the low, but the 4% of January of 2021 lows, okay? Now, this is why it's important. If you look back here, it says ARM shares fluctuate between 8 and 18% since the Great Recession, right? We are now above that rate. And if you look over here, this is why I think it's very important. Now, so many people in this world think that the guy with the big fancy mansion, the driving lawnmower, doesn't even have to push his own lawnmower, and the fancy dog is indeed rich. But I'm telling you right now, they're not. And this exact same thing was happening when I was an investor, selling all my homes, warning everybody in 2006 that a big real estate crash was coming, and everybody laughed at me. Here's the truth. Since April of 2023, all of these are going to have to do with the numbers from April of 2023. Loans above $1 million, for a conventional, they're not conventional, but your standard single family mortgage. 45% of them were adjustable rate mortgages. That's right. The middle class and upper middle class are fooling you. They don't own their homes, and 45% of all of the homes that were actually out there, the mortgages that were used to buy them, 45% of them adjustable rate mortgages. Now, what's happened since then? Rates are even higher than when they got into those ARMs. So they're finding it, even if they had to use an adjustable rate mortgage to buy their $1 million dream home, and they couldn't afford to get a 30-year fixed, they can't even get a 30-year fixed now. There is no way they can do it. Loans from $400,000 to $1 million, 17% of them were adjustable rate mortgages. Loans from $200,000 to $400,000, here, put down below if you can find a house for 200 grand in this country. You probably can't. 10% of them were ARMs. Okay, so that's good. That's good that the lower income people that are buying smaller homes are only 10% of them are in the ARM section. But think about this. This is like every bubble, whether it be a vehicle price bubble, real estate bubble, a stock bubble, it's always the people at the top with the most money that get hit the hardest and run for the exits the fastest. So the emperor has no clothes right here between these two. These numbers are very, very high. This one is exceptionally high, and this is what I'm getting excited for you to be able to buy here in the future, because What constitutes $1 million home these days? Well, it's really location, waterfront properties, great climates. The actual property, if it's in a normal town where the average home is $500,000, you go look at the $1 million homes and it's the land's more expansive. There's more uses of the property, things like that. These are the properties I want you taking advantage of when they go back to the banks. Because if you think about it, all these people that have been buying up homes since COVID, they can't afford them. And I want you to see these numbers because they are quite staggering. Now, back in the past, everybody likes to bring up these ninja loans. These were loans that had little to no documentation. Well, those are actually, some of them, a style of them are coming back. We have no income verification loans, again, with people that own businesses. They're slacking, they're pulling back a little bit on that. But I want you to remember, before they had ninja loans, because that's the last bet, negative amortization, no docs required, just a heart rate, right, a pulse to sign. Before that, they do what they're doing right now. They lower the threshold for down payments, and you've seen companies like Zillow come out and other large institutions, lending houses say, hey, you don't need to put 3% down to get a conventional rate, just give us 1%. You'll also see things like, you know what, you don't need as much documentation. You could state your income. That is exactly how all this started back then. Now the question is, a lot of people say when they ask me this, they go, well, yeah, but back then it took like a cycle of 3 years to go from normal rates to all of a sudden people fixed rates to people diving into adjustable rates. And then they started going into lesser documentation, less down payments, and then they finally ended up with ninja loans. And that was a period of 3 years. But you have to remember, right now, we are seeing rates rise so insanely fast because inflation has broken out of its cage and the Federal Reserve can't control it. So that means anything that happens in this cycle, as opposed to the last cycle, is going to be shrunk down in time. It's going to be more extreme. That's why you're seeing numbers coming out. Rates have increased to a 20-year high, literally in the matter of 2 years, less than 2 years. We are seeing everything compress because of how volatile this market is, because of how volatile and how serious inflation is. So you have to think that we're right around the corner from negative amortization loans. They will come back again. And what's crazy, if you think for a second that people are not going to dive into those, I just showed you how right now 45% of your supposed millionaires, the people that own the $1 million homes, are in adjustable rate mortgages. That was the first sign, the first crack in the dam when it came to the last real estate bubble and burst. Listen, I'm here to show you logical ways to get prepared for this next crash, just like I did. I learned lessons, even though I was ahead of the game and saved my tail and liquidated my properties. I still had a lot of lessons, and my goal is to teach you all those lessons. I'll put down a discount link, 80% off down below if you want to check it out. That's one time, and I keep adding court lessons. There are probably over 32 lessons now, and as things change to that market, that course is yours. Hope you guys have a great day. The Economic Ninja is out.